Hey there. Today, we're diving into something that's basically the secret sauce for building wealth in the stock market. It's this incredibly powerful force that works behind the scenes, and honestly, not enough people talk about it. Let's unlock it. So let me ask you this. When you think about making money from stocks, what's the first thing that pops into your head? Probably buying low and selling high, right? Watching that stock price just climb and climb. And yeah, that's a huge part of it. But it's only half the story. There's this other piece of the puzzle that over a long time can make an absolutely mind-blowing difference to your bottom line. To really see what I'm talking about, we're going to look at a pretty wild thought experiment. Picture this. You invest a single $1,000 into the S&P 500 way back in 1928. Then we just let it ride for 94 years, all the way to the end of 2021. We're going to see what happens to that $1,000 in 3 different scenarios. And trust me, the results are going to surprise you. All right, so first up is scenario A. Here, we're only counting the rise in stock prices. We're completely ignoring any dividends the company's paid out. Now, that $1,000 still turns into over $250,000. Not bad at all, right? A 6.1% annual return is nothing to sneeze at. But just think of this as our starting point. Okay, now for scenario B. This time, we do count the dividends. But in this case, every time a dividend was paid, we just took the cash and spent it. Just making that one simple change boosts the final number to over $380,000. That's over $100,000 extra just from collecting those payouts. A big jump for sure, but we're still not seeing the full picture. And here we go. Get ready for this? Scenario C. This time, instead of taking the cash, every single dividend was immediately used to buy more shares. That initial $1,000 didn't just grow, it absolutely exploded. It ballooned to over $7 million. I mean, that's not a typo. And get this, of that $7 million, only about $258,000 came from the original price growth. The rest, over 96% of the total return, came from that one simple decision to reinvest the dividends. So how on earth is that even possible? Well, the secret behind that $7 million number is a little thing called compounding. You've probably heard the term, but seeing it in action like that really shows you its power. It all comes down to 2 key ideas working together: dividend reinvestment and, you guessed it, the magic of compounding. Let's break them down. So first, let's talk about dividend reinvestment. It's actually a really simple strategy. When a company you've invested in pays out a dividend, instead of that money just hitting your bank account, you automatically use it to buy more shares of that same company. So every time you get paid a dividend, you're slightly increasing your ownership stake. And that little step is what sets the whole thing in motion. Because the next part of this 1-2 punch is compounding. And this is where the real magic happens. It's the process where your earnings, in this case, your dividends, start making their own earnings. You see, since you now own more shares, your next dividend payment is going to be a little bit bigger. And that bigger dividend buys even more shares, which then leads to an even bigger dividend the next time around. It's literally a financial snowball, just getting bigger and bigger and rolling faster and faster down the hill. This chart really makes it easy to see. Let's say you put $10,000 into a stock that pays a 5% dividend. Okay, after year 1, both strategies look identical. But check out year 2. If you reinvested, your starting principal is now higher, so your next dividend is $525, not $500. It's a small difference, but now let's jump forward 20 years. The investor who took the cash has $20,000. Not bad. But the reinvestor? Their portfolio is worth over $26,500. That extra $6,500 was created out of thin air just by letting your money make more money. So the math is pretty clear, right? It seems like a no-brainer. But that doesn't automatically mean that reinvesting is the right move for absolutely everyone. It really depends on your own personal financial goals and, frankly, where you are in your life. It's a choice every investor has to think about. And this really lays out the 2 main paths. If you're a long-term investor, someone with decades of work ahead of you, then reinvesting is almost always the way to go. It just puts your portfolio growth on hyperdrive and kind of forces you into a good habit automatically. But on the other hand, if you're retired or you're depending on that investment money to live, then taking the cash makes a ton of sense. You can use it to pay bills or maybe move it into something with less risk. It's all about matching the strategy to your season of life. Okay, so let's say you've decided that accelerating your portfolio growth is exactly what you want to do. How do you actually put this into practice? Let's go through a quick and easy playbook with some tips and, just as important, the risks you got to keep in mind. If you're just starting out, the name of the game is quality and consistency. You want to look for those big, stable companies that have been paying out and even raising their dividends for years and years. Then you want to make it easy on yourself. Pretty much every broker has something called a DRIP, a dividend reinvestment plan. You just find it in your account settings, check a box, and the whole process becomes automatic. It's usually free, too. If you want to spread your risk, you can look into dividend ETFs. And the most important tip, be patient. Compounding is powerful, but it needs time to work its magic. We're talking years, not months. But of course, it's not a perfect strategy. There are definitely risks. When you automate this, you could end up buying more shares of a company that's actually starting to perform poorly. It can also lead you to have way too much of your money tied up in a single stock, which is risky. Also, and this is a big one, even if you reinvest the dividend, you still have to pay taxes on it that year. And finally, just remember, a lot of amazing companies, especially fast-growing tech companies, don't pay dividends at all. They put all their profits back into growing the business. So when you really zoom out and look at the big picture, you see that reinvesting dividends isn't just some clever tactic. It's really a tool that helps you practice one of the most fundamental rules of successful investing, discipline. It forces you to stay in the game and consistently buy more, which is especially important when the market gets scary. Just look at the data from some of the biggest market crashes in history. After the dot-com bubble burst, it took 86 months for the market to recover. 86. People who panicked and sold locked in massive losses. But the investors who held on and who kept reinvesting their dividends were basically buying up more shares at a huge discount. That kind of discipline doesn't just help you recover, it supercharges that compounding engine for the rebound that history shows us always comes eventually. And really, that's what this all boils down to. This isn't some get-rich-quick scheme. It's about a patient, disciplined, almost boring approach to building real wealth over a long period of time. Dividend reinvestment basically turns your portfolio into a self-fueling engine for growth. And the thing to remember is that every small dividend, every tiny fractional share that gets added to your account, is just one more little push on that financial snowball, helping it grow into something much, much bigger for your future.